Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Was reading this kind of back and forth between people, and I've seen some other comments sprinkled throughout a whole bunch of comments in here, and I'm going to kind of go over it and give you my opinion. My viewpoint, I think, is different than a lot of people, and I see this a lot. It's a common thing that people always ask or make comments on. And here's one of the things. It says oil price may hit its head on 90, then go back down to 60. And then there's a lot of talking back and forth. You know, there's zero chance we hit 60s anytime soon. There's people, that seems too confident in the most. You guys are going back and forth about short-term price movements. And I hear a lot of questions like, should we short the NASDAQ? Should we go and short these other companies? Should we sell and then buy back uranium when it comes down? Should we be doing all these actions? All right. This is what I've found. I've found that if you are having that viewpoint, if you're trying to make predictions in the very short term, if you're making decisions based off of short-term movements, that it will drastically reduce your returns. I'm going to say it again. If you are making decisions based off of short-term fluctuations, and you are trying to time the short-term movements, that it's going to drastically reduce your returns over this long-term bull market. The short term is very hard to predict, and I don't think it is predictable. It is very hard to get back out, get back in, get back out, get back in, and time it very well. There's going to be tax implications that you're going to have your returns be greater than those taxes. And some people are maybe able to do it. Maybe it's sheer luck. Maybe it's a form of luck and skill where it works out for them. If you guys aren't professional traders, if you have no edge, in my opinion, I wouldn't be doing that. We know that the market conditions are becoming more favorable for commodities. We know that that a lot of these areas are cheap. In my opinion, and what I've experienced, is it's easiest just to buy the dips, hold on, and ride it higher. What it does is it takes all of the stress and it takes all of the short-term noise and all of this unneeded, unnecessary price movements and how that interacts with the human and your emotions. It takes it all away. And it just says, it's a simple strategy. It's like, buy when it's cheap, continue to cost average in, we get a pullback. I'm not making predictions. I know that this pullback is cheap. It looks like it's turning around. Let's add some money in. And even if you're wrong, you've got your time and your valuation at your back behind you. Now, if you're trying to play the short-term market with all of your money and you're going all in, all out, all in, all out, you can get absolutely slaughtered in these highly volatile companies doing that. You mistime something. You miss a 20% move up or a 50% move up. Some of these, they moved 100% in like a month. What if you're out and you get that 100% move? What are you going to do? Are you going to go back in at 100% higher and then they get slaughtered to the downside again based off of short-term movements and volatility? Guys, it's going to hit you in the short term. You're going to be left out. I'm just going to tell you that. It's too hard to time. So what I did and what my plan and strategy is, and you guys can adopt it or not, you can do whatever you want. This is just my financial opinion, is when things are down and they're cheap, I pile in and then I hold on. You got to be buying when they're down, not buying when something's up and you're chasing. For instance, I would be laser looking at uranium right now and looking for a turning point. Because if you get a turning point, remember, we could be faked out a few times, and that's why cost averaging in. You come in and it turns up, and then it may come down even some more again. It may bounce around a while. But I would buy it when it's down, not when it's up. And right now, uranium's getting a pretty big pullback. And that's when I look to purchase. Now, what makes me so confident that uranium is going to go up again? its valuation, it's below the cost curves, that's when you buy. And we're in the market conditions for uranium to go up. The liquidity flows are coming into the commodity sector, I think, in ever greater quantities over time, so long that the expansion phase of real estate exists. That's your liquidity generator. And what causes interest rates to go up. So if we continually see interest rates going up, which I think they will, I think commodities are going to have a huge move in front of us. And if it's a really big move, again, guys, I wouldn't be worried about the short-term movements. It's too much worrying about the short-term movements that I'm reading in the comment section. So what I would be looking at is you got to focus on the thesis. Just like shut your eyes and be like, what should I focus on? The thesis. What is the thesis of the channel? Look at the description link in the below. I've got videos posted in below of what the thesis is. The thesis is real estate housing starts. If they go up and the volume goes up, that means more loans come into the system. It's a credit expansion. That means that the market conditions are ripe for a commodity boom. As long as those remain pretty steady and are up there in an expansion phase of real estate, I would be quite bullish on commodities. Don't worry about the short-term movements. Yes, you're going to have to ride through it. That is something that you're going to have to mature and develop as an investor, where the short-term movements are just noise. Block it out. Focus on a strategy. Your strategy should be buy the dips. Not buy the rips, buy the dips. When it dips down, buy it when it's low. Let it ride higher. Nova Royalty, what we were doing, I was buying the dip. If you listen to my daily technical updates and you start hearing me say, I'd be a buyer here, that's where I buy. That's me. I'm buying when things are down, not when they're up. Would I buy precious metals mining companies? I would. I would buy precious metals mining companies now. I just slowly accumulate, just keep accumulating. And then when that goes up, I wouldn't chase. I'd look. Would I buy uranium right now? Yeah, I'd be looking at it for sure. Buy this dip, just slowly let leak in, slowly move. You want to buy $1,000 worth? Buy $100. Goes down $1. Buy another $100. Goes down $1. Buy another $100. It goes up $100 or $1. Buy another $100. Like buy on the movements. Either buy into strength or buy when it's bouncing on a bottom or something. Try to find where that's bottoming at. If you find that it's bottoming at this, I'm just going to make up a number, $70 price of something. Buy it at 70, put an order in there, put an order in there, put an order in there. If it's dipping below and coming back up, try to get it at 69.50. Try to make fun of it, make it fun. Try to get the cheapest price you possibly can. And if you're cost averaging in, that's the way that you can kind of cost average the entire dip. You'll get the best, lowest price. And sometimes people get lucky, and you know what? That's just sheer luck. What you're doing is you're taking the luck out of it and you're systematically approaching something. But just because your account goes, you're never going to have your account go straight up, like vertically. You're never going to time this stuff perfect. It just doesn't work that way. The markets are quite volatile in the short term, and people's emotions kind of rule that short term. But the market in the long term, if we have an energy crisis, which we have, if energy is going to get more expensive, if we're going to put ESG mandates and all that, and carbon credits and all this other stuff, if there's a premium on emissions, nuclear is a pretty good bet. Uranium is in the nuclear section. I don't think that we can produce enough electricity worldwide for the majority of our electricity to come from renewables. I don't know if we have the minerals in the ground to do it. I think that we don't have enough graphite and cobalt and nickel and copper and all these minerals to drastically ramp up the renewable production and then continually do it and replacing everything every 10 to 20 years. I just don't think we're going to do that. We have to become a lot more efficient with our energy use, and we're going to have to find different energy sources of energy. And the only thing that I think that we can find is probably fusion. We have to continually go up the energy return on investment structure to progress humans forward. Renewables, I think, is a step in the backward direction. And we've never been able to generate power ourselves. We've only been able to gather it from society. or gather it from the sun. We've never been able to figure out a way to produce energy. It's always been from gathering it out of our environment, which is fossil fuels, or gathering it from the sun, or gathering it from water, moving water, something. It's always been gathering, a gathering mode. So the difference between me and even if you I talked to Trader Ferg, I talked to these guys who are uranium experts and whatnot. None of us are trading in and out. None of us. So what makes you think that your ideas are of trading in and out is going to work? I've tried it. I don't like it. I'm sure all these other guys have tried it too. So be careful in making price predictions in the short term. Be careful of making investment decisions on the short term. Short term being anything less than a year is a short term type movement. So you think that, oh, it's going to go up or down. This guy, whoever it is on Twitter, thinks that oil is going to go to $60 a barrel. This person who does technical analysis thinks that the oil price or uranium price is going to go down in the short term. Just be careful, because the short term is the hardest, least reliable thing to predict and to be accurate. And price projections, they're not right either for the majority of it. I don't even dwell on price projections. What I look at is, are the market conditions good? Is the liquidity flows coming in? And are the ratios changing in a favorable direction? If that is yes, 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 be long. If it's no, and starting to change and it all turns to no, 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 you get out. It's that simple. And whatever's left, whatever gain you have, is the gain that you're going to get. It's important of the sell point and the buy point and being able to value those assets. So I think that it's more important to focus all of your efforts on figuring out how to value assets and how to monitor and verify that the thesis is intact and that the strategies you are deploying are still in a favorable market condition environment. That is where your efforts should be focused at. Focusing on what the short-term movements are going to do, and all of these people talking about it, and I think it's great entertainment. I think it's great things to talk about, and I think it's something that you can maybe watch for and mentally prepare for. But I'm just going to say this: what if these guys are predicting a move to $60 a barrel oil? What if that never materializes? What if we go straight to 150? And you sold based off of that short-term price movement. Now, let's say we do go to 60, all right? Let's say in the short term we do go to 60, and eventually it heads up going to 150. It just took a little bit longer. We did a little bit of a detour there. Did it hurt the person who held through it? No, you just had to go through some short-term pain of holding on through that pullback. Now, let's look at the strategy that I would deploy in that. We came in, and my strategy is to buy the dip. All right? So we came up, and let's say it goes straight to 150 from where we are today. I win, right? And let's say the detour, we took a detour to 60 first, and then we go to 150 after. I buy the dip, but I don't sell my original position. I win. Now, let's say someone says, in this type of scenario, I'm going to sell my oil stocks at because I think this prediction that this person has, or whomever has, and goes down to 60. Let's say I sell it and we go straight to 150. I lose big. I lost, and that valuation, I sold when oil was at a very good valuation in good market conditions. I sold out and I never got back in, and I lost that big move. And the oil companies went up another 5 to 10x. Now, if it comes back and you're right, maybe you get back in at the bottom. Maybe you don't. It's tough to say. But you could win a little bit more. You could. You can maybe win, maybe you get another 25, 30% or 40% more. If you're right on the short term, which is the least probability. It's the hardest thing to do. The short-term movements are very hard to predict and get right. So let's take the short-term noise out of it. Let's take the lower probability out of it. And let's take the highest probability of success. What's the highest probability of success? Holding, getting a strategy, buy the dips. If the market conditions are ripe and the valuations are good. If those two things are good, stay long, guys. That's my opinion. Stay long, hold on, buy the dips. If you don't get a dip, you're long anyway. You still win. The valuations are good and you're riding it higher. So that's my approach. Just be careful on all this short-term stuff. I don't play the short term. I buy the dips. And that's exactly what I've implemented in every single thing. And my strategy has worked very well for me over the long periods of time. I'm continuing to buy platinum. I bought it on the dip in the medical event. I bought it before that and I had a loss. I had a loss, and what did I do? I doubled down, tripled down. I bought everything I could when it was really low. And I continue to buy because the valuations are good. I bought the dip. I'm holding on. So that's where I'm going to end it. Hopefully you guys like this analysis. Give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.